If you receive Social Security, the 2026 COLA announcement is going to change your monthly check. Most people think they understand how this adjustment works, but they really do not. There are at least 3 major factors in the 2026 COLA that could either help you or quietly cost you hundreds of dollars. I spent my entire career helping people like you protect every dollar they earned, and today I am laying it all out. Right now, millions of seniors are waiting to find out what their 2026 cost of living adjustment will actually be. The early projections are already circulating, and the numbers tell an important story. What concerns me is that very few people know how to read between the lines of this announcement. By the end of this video, you will know exactly what to expect and what to do about it. This is not just about a percentage increase printed on a piece of paper from the Social Security Administration. This is about your grocery bill, your rent, your prescription costs, and your ability to live with dignity. I have seen too many good people lose money simply because they did not have the right information at the right time. So please, stay with me for the next 20 minutes, because this could be one of the most important videos you watch this year. Let me start with some important context so we are all on the same page together. The Social Security Cost of Living Adjustment, known as the COLA, is an annual increase to your monthly benefit. It is designed to help your check keep up with rising prices for things like food, gas, and medical care. The Social Security Administration calculates it using a government measure of inflation called the Consumer Price Index for Urban Wage Earners, or CPIW. In 2024, the COLA was 3.2%, which gave the average retiree about $59 more per month. In 2025, the COLA came in at 2.5%. Adding roughly $49 to the average monthly benefit according to SSA. UF Now for 2026, early estimates from the Senior Citizens League and other nonpartisan groups project a COLA of somewhere between 2.2 and 2.5%. That would mean an increase of roughly $39 to $48 per month for the average retired worker receiving about $1,976 a month. Now here is where it gets tricky. And this is what most people do not understand. That COLA percentage is not calculated based on what you actually spend your money on as a senior. The CPIW measures spending patterns of younger urban workers, not retirees who spend far more on healthcare. This mismatch has been a quiet problem for decades, and in 2026, it matters more than ever. Think of it this way. Imagine you go to the grocery store and the government says prices went up 2%. But the items you actually buy, like medications, doctor visits, and supplemental insurance, went up 5 or 6%. Your COLA raise covers the general inflation, but it does not cover your real inflation as a senior. According to the Bureau of Labor Statistics, healthcare costs for seniors have been rising at roughly double the rate of overall inflation in recent years. The CMS data from Medicare.gov shows that Part B premiums, Part D costs, and out-of-pocket expenses continue to climb. So when you hear that 2026 COLA number, remember that it may not stretch as far as you expect. This is exactly why understanding the full picture is so critical for your financial well-being. Now let me walk you through the first major insight about the 2026 COLA that most people completely miss. Your COLA increase is announced in October, but it does not show up in your check until January. Between that announcement and January, several other changes are also finalized, including your Medicare Part B premium for the new year. And here is the painful truth. If your Part B premium goes up, it gets deducted from your Social Security check automatically. Let me show you what this looks like with real numbers so you can see the impact clearly. Say your current Social Security benefit is $1,900 per month before any deductions in 2025. A 2.3% COLA for 2026 would add approximately $43.70 to your monthly check. That sounds like a nice little raise, right? But now let us factor in the Medicare Part B premium increase. In 2025, the standard Part B premium is $185 per month, according to CMS. Yablum. COLA raise every single month. So instead of getting an extra $43.70 per month, you might only see an actual increase of $31 to $38 in your bank account. That is a real difference of roughly $60 to $150 over the course of a full year. For someone living on a fixed income, that money matters enormously. And this does not even account for other deductions that might also increase. Let me give you a specific example. My neighbor Barbara retired 3 years ago with a Social Security benefit of $100 per month. After the 2025 COLA, her gross benefit went up by about $52, but her Part B premium increased, her Part D premium went up slightly, and her Medigap plan raised its rates by $14 per month. When Barbara added it all up, her net increase was only $19 per month. She expected $52 more, but she only got $19 more in her actual deposit. That is a gap of $33 per month, or $396 per year that she thought she would have but did not. Barbara's situation is not unusual at all, and it could easily happen to you in 2026. Now let us talk about another factor that can silently reduce your 2026 COLA benefit. If you are paying federal income taxes on your Social Security benefits, a higher gross benefit means potentially more of your Social Security becomes taxable. The income thresholds for taxing Social Security have not been adjusted for inflation since 1984. This means more and more seniors get pulled into paying taxes on their benefits every single year. Here is how it works. If your combined income is between $25,000 and $34,000 as a single filer, up to 50% of your Social Security benefits may be taxable. If your combined income is above $34,000 as a single filer, up to 85% of your benefits could be taxable. For married couples filing jointly, those thresholds are $32,000 and $44,000, and these numbers come directly from the IRS. So your 2026 COLA raise could push you over one of these thresholds if you are right on the edge. That means you could owe more in federal taxes on benefits that you already paid into your entire working life. A $43 monthly COLA increase could trigger hundreds of dollars in additional annual tax liability. Very few people see this coming until they file their taxes the following spring and get an unpleasant surprise. Let me put this in perspective with another quick example. Suppose you are a single filer with a pension of $15,000 per year and Social Security benefits of $22,000 per year. Your combined income puts you right around the $34,000 threshold for higher taxation of your benefits. A COLA increase of even $500 per year could push you over that line and make 85% of your benefits taxable instead of 50%. Stay with me, because what I am about to show you will surprise you. There is a way to manage this tax situation, and most financial advisors do not even mention it to their retired clients. It involves understanding provisional income and making strategic decisions about other income sources. I will get to that in a moment, but first, let me cover the second major insight about the 2026 COLA. The second big thing you need to understand about the 2026 COLA is how it interacts with means-tested programs. If you receive supplemental security income, Medicaid, SNAP benefits, or any other need-based assistance, a COLA increase can actually make you lose eligibility. The income thresholds for these programs are extremely tight, and even a small increase can push you over the limit. This is one of the most heartbreaking things I saw repeatedly during my career as a financial advisor. Let me explain this with a real scenario. Suppose you are a widow receiving $50 per month in Social Security, and you also qualify for extra help with your Part D prescription drug costs. The income limit for extra help in 2025 is $900 per month for an individual according to SSA.gov. A COLA increase of $25 per month might not push you over that particular limit, but other program thresholds are much lower and tighter. For example, some state Medicaid programs have income limits as low as $255 per month for an individual in 2025. If your Social Security benefit is $250 per month for an individual in 2025, if your Social Security benefit is $cliff, and it is a very real problem for millions of American seniors. You get a tiny raise from the COLA, but you lose a much larger benefit from another program. The net effect is that you are actually worse off financially after the COLA than you were before it. Understanding this is absolutely essential if you rely on any means-tested benefits alongside your Social Security. Here is what I recommend you do right now if you think this might affect you in 20. Contact your local state health insurance assistance program, also known as SHIP. They offer free, unbiased counseling to help you understand how changes in your income affect your benefits. You can find your local SHIP office at shiphelp.org or by calling 1-877-839-2675. Another critically important thing about the 2026 COLA involves timing and your first benefit year. If you just started receiving Social Security benefits in 2025, your first COLA will be prorated based on when you began collecting. Many new retirees do not realize that you do not get the full COLA percentage in your first year of benefits. The proration is based on the month you became eligible, not the month you filed your application. For example, if you turned 62 in July 2025 and started receiving benefits in August 2025, your 2026 COLA will be prorated. You would only receive about 5/12 of the full COLA percentage because you were only eligible for 5 months of 2025. On a 2.3% COLA, instead of getting the full percentage applied to your benefit, you might only see about a 0.96% increase. That could mean the difference between an extra $43 per month and only an extra $18 per month. This catches a lot of new retirees off guard because they hear the COLA number on the news and expect the full increase. The SSA does not do a great job of communicating this proration rule to new beneficiaries. You can verify your specific COLA calculation by logging into your My Social Security account at SSA.gov. I strongly encourage you to do this in January 2026 when your new benefit amount is posted. Let me also address a question I get asked all the time about COLA and spousal benefits. If you receive spousal benefits based on your husband or wife's work record, you do get the COLA increase. The COLA is applied to all Social Security benefit types, including retirement, spousal, survivor, and disability benefits. However, the dollar amount of your increase depends on the size of your current benefit, not your spouse's benefit amount. So if your spousal benefit is $900 per month and the COLA is 2.3%, your increase would be about $20.70 per month. Your spouse might get a larger dollar increase because their benefit is higher, but the percentage is the same for everyone. This means that the gap between lower benefit and higher benefit recipients actually grows wider with each COLA. Over 10 years, this compounding effect can mean a difference of thousands of dollars. Now here is the part most seniors never hear about. There are specific strategies you can use to maximize the value of your 2026 COLA and protect yourself from the hidden costs I have been describing. These strategies are completely legal, widely available, and endorsed by financial planners who specialize in retirement income. But for some reason, they rarely get discussed on the evening news or in the letters you get from the Social Security Administration. The first strategy involves reviewing your Medicare coverage during the annual enrollment period, which runs from October 15th to December 7th. Most seniors stick with the same Medicare plan year after year and never shop around. But if your Part D plan is increasing its premium or changing its formulary, switching plans could save you $20 to $60 per month. That savings alone could more than offset the Part B premium increase that would otherwise eat into your COLA. According to CMS, the average Part D premium in 2025 is about 46.50 cents per month. Some plans charge as little as $8 per month, while others charge $90 or more. If you are paying a high Part D premium simply because you have not reviewed your options, you could be leaving hundreds of dollars on the table. Comparing plans takes about 30 minutes on Medicare. The mass when much of you gas, tama biguz. But now come. The mass blacked of you gas, the mass blacked of you gas, you kudio can. To can. Their mere janjuro. You. Non-Medicare savings programs. QMB, SLMB, QI, and QDWI. The Qualified Medicare Beneficiary Program, or QMB, pays your Part B premium, deductibles, and copayments for you. In 2025, the income limit for QMB is $1,255 per month for an individual and $1,704 per month for a married couple. If you qualify for the SLMB or Specified Low-Income Medicare Beneficiary Program, the state will pay your Part B premium for you. The income limit for SLMB in 2025 is $1,506 per month for an individual. This means that if your Social Security check is under approximately $1,506 per month, your state could be paying that $185 Part B premium for you right now. That would save you $220 per year, which is far more than any COLA increase could ever give you. The third strategy involves managing your provisional income to avoid higher taxation of your Social Security benefits. If you have a traditional IRA or 401k, consider doing partial Roth conversions in years when your income is lower. By converting some traditional retirement funds to a Roth IRA, you pay taxes now at a potentially lower rate. This can reduce your required minimum distributions later and help keep your provisional income below the taxation thresholds I mentioned earlier. Now I want to walk you through a detailed comparison so you can see how different scenarios play out for the 2026 COLA. Let us look at 3 different retirees and see how the same COLA percentage affects each of them differently. This will show you why a one-size-fits-all approach to retirement planning simply does not work. Each of these scenarios is based on real situations I encountered during my years as a financial advisor. Retiree number 1 is named Frank. Frank is 68, single, and receives $1 turn month in Social Security. He has no pension and lives primarily on his Social Security benefit in a low-cost area. A 2.3% COLA would give Frank an extra $36.80 per month, bringing his gross benefit to $1,636.06. After the projected Part B premium increase, Frank's net gain might be about $29 per month. Frank does not have income above the taxation threshold, so he pays no federal taxes on his Social Security. He also qualifies for SNAP benefits and the low-income subsidy for his Part D drugs. Frank's biggest risk is that his COLA could push him over a Medicaid or SNAP threshold, so he needs to verify his eligibility immediately. Retiree number 2 is Margaret. Margaret is 72, married, and she and her husband have a combined Social Security income of $4,200 per month. They also have a small pension of $800 per month and some savings in a traditional IRA. A 2.3% COLA would give Margaret and her husband a combined increase of about $96.60 per month. However, Margaret and her husband are already above the $44,000 combined income threshold for married couples. This means 85% of their Social Security benefits are subject to federal income tax. Their COLA increase of $96.60 per month adds about $1,159 per year to their gross Social Security income. After taxes, their actual gain might only be about $60 per month or $720 per year. Retiree number 3 is James. James is 64, recently retired, and started collecting Social Security at 62 with a reduced benefit of $350 per month. Because James claimed early, his benefit is permanently reduced by about 25% compared to his full retirement age benefit. James also started benefits in the middle of 2025, so his 2026 COLA will be prorated as we discussed earlier. James might only see an increase of about $15 to $18 per month from the 2026 COLA. On top of that, James is paying for his own health insurance until he turns 65 and qualifies for Medicare. His health insurance premiums through the marketplace are $650 per month, even with subsidies. James is in the tightest financial situation of all 3 retirees, and his COLA will help him the least. These 3 examples illustrate why you cannot just listen to the headline COLA number and assume you know what is happening with your money. Your specific situation determines whether the COLA truly helps you, barely helps you, or potentially hurts you. The only way to know for sure is to calculate your own numbers using your actual benefit amount, your deductions, and your total income. And that is exactly what I want to help you do today. Now let me share the hidden gem that I promised you at the beginning of this video. There is a provision in that most seniors have never heard of. This rule protects most Social Security recipients from a net decrease in their check due to Medicare Part B premium increases. Essentially, if the Part B increase would eat your entire COLA and then some, the hold harmless rule caps the Part B increase for you. Here is how hold harmless works in practical terms. If the standard Part B premium increase would cause your Social Security check to go down from one year to the next, your Part B premium is limited. Your premium will only increase by the dollar amount of your COLA, not the full standard premium increase. This means you will never see your actual Social Security deposit decrease from one year to the next solely because of Part B premiums. However, and this is critically important, the hold harmless rule does not protect everyone. It does not apply if you are newly enrolled in Medicare Part B during the year. It does not apply if you are subject to the income-related monthly adjustment amount, known as IRMAA, which affects higher income beneficiaries. And it does not apply if your Part B premium is not being deducted from your Social Security check. According to SSA.gov, about 70% of Social Security recipients are protected by the hold harmless provision in any given year. If you are in the protected group, you can rest a little easier knowing your check will not shrink. But if you are in the 30% who are not protected, you need to plan carefully for the potential impact. Check your Medicare Part B billing method to confirm whether the hold harmless rule applies to your situation. There is another hidden benefit that many seniors overlook, and it connects directly to the 2026 COLA. If you are still working while receiving Social Security and your current earnings are higher than one of your previous 35 highest earning years, Social Security will automatically recalculate your benefit. This recalculation can increase your benefit beyond just the COLA adjustment. You could see both a COLA increase and an earnings-based recalculation applied to your 2026 benefit. For example, suppose you are 67 and still working part-time, earning $25 per year. If one of your previous 35 lowest earning years was $8,000, your current earnings would replace that lower year in the benefit calculation. This could add an additional $15 to $30 per month to your benefit on top of the COLA. The Social Security Administration does this recalculation automatically, but it sometimes takes until October of the following year to show up. Now let me give you your specific action steps so you can protect your money heading into 2026. These are things you should do in the next 30 to 60 days, and none of them cost you a single penny. Taking these steps now will put you ahead of the vast majority of seniors who will just wait and hope for the best. Being proactive with your benefits is the single most important habit I can encourage you to develop. Action step number 1. Log into your My Social Security account at SSA.gov and review your current benefit statement. If you do not have an online account, create one today at SSA.gov. An online account. This will show you your current benefit amount, your expected COLA increase when it is announced, and any deductions being taken from your check. Write down your current gross benefit and your current net deposit amount so you can compare them to your January 2026 numbers. Action step number 2. During the Medicare annual enrollment period from October 15th to December 7th, review your Medicare Part D and Medicare Advantage plans on Medicare.gov. You can also call 1-800-MEDICARE, which is 1-800-633-4227, to get help comparing plans over the phone. If your current plan is increasing premiums or changing drug coverage, switching could save you $200 to $700 per year. This is free to do, and it takes less than an hour. Action step number 3. Check your eligibility for the Medicare Savings Programs and the Extra Help Program for prescription drugs. You can apply for extra help at SSA.gov or by calling Social Security at 1-800-772-1213. For Medicare Savings Programs, contact your state Medicaid office or your local SHIP counselor at SHIP Help Low. These programs could save adding roughly $39 to $48 per month to the average retirement benefit. But your actual gain depends on Medicare premium increases, tax implications, means-tested benefit thresholds, and whether the hold harmless rule protects you. The seniors who come out ahead are the ones who understand these moving parts and take action before the changes hit their bank accounts in January. Thank you so much for spending this time with me today. If this information was helpful to you, I would be grateful if you would subscribe to this channel so I can keep bringing you videos like this one. Next time, I am going to break down a major change coming to Medicare Part D in 2026 that could save you thousands of dollars on prescription drugs. This channel is for educational purposes only and does not constitute financial or legal advice. Always verify directly with SSA Gov or Medicare. And Gov